All right, we're looking at the Sigma Investment Management case study here. Let's read question 1 and then we'll jump into the paragraph. Explain the role of benchmark spread analysis in Ross's credit risk assessment in portfolio management strategy. How do G spread and Z spread contribute to these efforts? So we're kind of being asked what are spreads and how does that relate to credit risk, and then what's the difference between G spread and Z spread. Sigma Investment Management, a reputable fund focusing on fixed income securities, is revising its credit strategy to adapt to changing interest rate environments and evolving credit market conditions. The credit team, led by Malcolm Ross, CFA, faces questions about using various spread measures and the implications for their portfolio strategies. Credit spread analysis and investment actions. SIM's current portfolio includes a range of corporate bonds with various yields, maturities, and credit risks. Ross emphasizes the importance of thorough credit spread analysis using G spreads, I spreads, and Z spreads to understand the risk premium over government securities and liquid swap benchmarks. The analysis influences investment actions from trading activities to portfolio rebalancing. It looks like we have all the information we need here. We're kind of discussing a little bit about the portfolio strategy process and credit spread analysis and those two types of credit spreads, G spread and Z spreads. So I'm just going to pull in the 3 bullet point answer here. So for the explain portion, that's going to be this first part. Spreads measure additional yield over risk-free bonds, and then the amount of yield is typically commensurate with level of credit risk, so more spread equals more credit risk. So that's how the spread analysis plays into the credit risk assessment and portfolio management strategy. The amount of spread we're going to take on is going to tell us how much credit risk we're taking. So that would be 1 point for you there. And then we're going to get another point for another 2 points for the G spread and Z spread. So how do G spread and Z spread contribute to these efforts? G spread is measuring the yield over government bond yield of the same maturity. So this is giving us a measure of credit risk for at a specific point in time for a security relative to that same maturity. So this is going to be kind of pure credit spread, 1-to-1 bonds in the portfolio. And then Z spread measures the spread over the entire spot curve, helps give a more accurate picture of the term structure of interest rates. So the keys here are the Z spread is kind of telling us the whole term structure of interest rates. G spread is just giving it for that one maturity. So yeah, you'd get 1 point for each of those right there. Question 2, discuss how SIM can utilize the I spread versus the G spread to better compare yields between a corporate bond and a swap transaction, especially when liquidity concerns surface. So let's read a little bit. I think we've gotten to all the information we need, but let's read a little bit more. Choices across credit spectrums. Ross evaluates the team approach to investment grade and high yield bonds, considering the different risk profiles. He navigates financial market nuances and regulatory concerns while managing the risk and returns expectations efficiently. So no new info there. So essentially what we need to do here is kind of differentiate between the I spread and the G spread, and then kind of tell which one would be better, or for kind of evaluating the yields between a corporate bond and swaps, especially when liquidity concerns surface. All right. So I'm going to pull this in. So I'm just giving here G spread measures the bond yields over a comparable government bond. I spread measures bond yield over swap of the same maturity. So the G spread is measuring cash bonds, whereas the I spread is measuring swaps. So that's going to be key here for the kind of discussion part. So spreads tell us what the risk is. And so liquidity concerns will be priced into the I spread risk premium. So essentially, because the I spread is the yield over the swap of the same maturity, the spread is telling us the risk. So liquidity concerns should be priced into that risk by the market. So yeah, I think you'd get 1 point here for kind of differentiating between the two, and then another point for the discussion, or maybe just 1 here, 2 for the discussion. Question 3, Given the credit quality spectrum, explain how investment actions are likely to differ between investment grade and high yield bonds. Determine 3 important considerations when allocating to each category. So we already read this in the last question, but let's just read over it again. Ross evaluates the team's approach to investment grade and high yield bonds, considering the different risk profiles. He navigates financial market nuances and regulatory considerations while managing the risk and return expectations efficiently. So we're looking at investment grade high yield. And so the first part of the question, explain how investment actions are likely to differ between investment grade and high yield bonds. So investment grade bonds are going to be, I think the rating is BBB and up. So they're typically going to be safer. And then high yield are going to be BBB minus and below. So they have essentially more default risk. So high investment grade bonds are going to have lower yields and lower spreads relative to treasuries, and high yield bonds are going to have higher spreads and higher yields relative to treasuries. So basically investment grade is less risky. So the investment actions for investment grade, this is typically going to use for the defensive part of a portfolio, and we're going to be aimed at earning yield while earning some yield, but the main goal here is preserving capital. This is typically going to be used by risk-averse investors that just want to earn some type of return but want to preserve capital, or investors with upcoming cash flow needs and that are doing some type of liability matching and they just need some return on their money. And that can be an individual or like an insurance company. And then for high yield, we're looking to have a greater return, but at the risk of greater defaults, has more credit risk, so should be used by an investor with higher ability to take risk in fixed income. So somebody that maybe isn't counting on any upcoming cash flow needs or is less concerned with preserving capital. So that is the explain portion. And then for the determine 3 important considerations, I think there's more than just 3, but these are three important ones. So default rates, recovery rates, and macroeconomic environment. You want to balance these risks relative to the spread and yield that we're earning. So if the main thing between default rates and recovery rates is default rates will be lower for investment grade. Recovery rates could be mixed between the two, but high yield is going to have much higher default rates. So that's taking into account the relative default rate for the yield that you're going to be able to earn in high yield is something that needs to be considered. And then the big one here is macroeconomic environment and just where we are in the credit cycle. If we're earlier cycle and coming out of a recession, then spreads are probably a little high and you're going to earn more yield, and those spreads will potentially tighten and provide some price appreciation on high yield. But if we're later cycle, then you might want to be more defensively positioned in investment grade. So yeah, that's the explain and determine portions there. Question 4. Describe 3 reasons why the option-adjusted spread would be considered more appropriate for Ross when managing bonds with embedded options. We left off right here. Adapting to market challenges. In light of tightened credit spreads and increased risk of default in specific sectors, Ross also considers the option-adjusted spread to account for embedded bonds, embedded options, and better quantify the potential risk return of trade-offs. So we're just looking for 3 reasons why the option-adjusted spread would be considered more appropriate when considering these types of bonds. So the OAS captures the value of the option in the price of the bond, which is going to be important for bonds with embedded options because we're paying for the bond and that option, or we're receiving extra payment for that option if it could get called away. So we're capturing the value of the option in the price. Therefore, this helps weight the decision of taking higher yield with the chance of getting called away and losing that yield. So when you buy a bond that can get called away, typically it will have a higher starting yield, but you may not be able to hold that bond for the duration of the terms of the bond, just because if yields fall, the issuer then is going to is going to call the bond back and then reissue debt at the lower yield. And then two other things, and these are kind of pretty related, but we're going to capture the true credit spread by adjusting for that option, and then which will also in turn reflect the true credit risk of the bond by adjusting for that option. So those are three reasons there.